Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. In this week's video, we'll go over The Little Book of Common Sense Investing by John C. Bogle. Today's video is broken up into three key parts. Number one, the importance of careful consideration when making an investment. Number two, the power of the index fund. And number three, despite the possibility of failure, you've got to be in it to win it. John C. Bogle was the founder and chief executive officer of the well-known investment advisor, the Vanguard Group. He is even credited with creating the first index fund. In his sixth book, he writes that the simplest and most efficient strategy is to buy and hold all of the nation's publicly held businesses at a much lower cost. Let's look at how we can put Bogle's writing into practice with our own investments. First, we'll look at the importance of careful consideration when making an investment. Many take a hands-off approach to investing, choosing to pool funds into actively managed funds. While this may carry some benefits, Bogle explains that the more the managers and brokers take, the less investors make. An actively managed fund takes money that has been pooled from multiple investors. Then investment choices are made by a specialized fund manager who continues to evaluate and adjust regularly. This can end up being costly in more than one way. Brokerage commissions for the fund manager and firm can reduce your rates of return, and although some funds may perform exceptionally well, they are more likely to lose money in the long run or not outperform the S&P 500. Bogle's simplified approach is to self-manage investments in general index funds. Speculation and trying to time the market, which fund managers are essentially attempting, is a losing strategy. Fees have a nasty way of sneaking up on you. Consider if you had made a $10,000 investment in 1980, by 2005, you might have ended up with 70% less in returns if you had invested in an active fund rather than an index fund. And that's only considering the brokerage fees. As usual, when it comes to making investment decisions, make sure to weigh the pros and cons before making investments. If you choose to work with mutual funds, make sure you understand the fine print. What are the maintenance fees associated with the brokerage, such as performance and portfolio fees? Investors often undervalue the actual cost of these funds, and fund managers rarely go out of their way to be transparent. I wish I could tell you this is the exception rather than the rule. In the late 1990s, 198 of the 200 most successful funds reported higher returns than the investors actually received. I'd like you to consider one last statistic regarding active or mutual funds. Only 24% of the 355 mutual funds that existed in 1970 have consistently outperformed the market and are still in operation. That is less than 7% chance that you'll select a fund that you'll see a higher return than the overall stock market. Furthermore, consider the human factor behind these strategies. Even if you find a mutual fund that has consistently topped the market in the last several years, it has been thanks to the human overseeing that fund. What happens when that person retires, moves to another position, or otherwise vacates that role? Will their replacement have the same track record? They'll need several at-risk years to prove it to you. People are also simply subject to investment hype, misleading marketing, and a slew of other clever tactics and shiny objects designed to distract you from otherwise savvy investors. We need not look any further than the late 90s high-risk investments. In the first half of the decade, $18 billion was invested in the stock market. In the second half of the decade, while the market thrived and stock values were artificially inflated due to the market hype, $420 billion was pumped into the market. When the bubble burst, it was too late for people to realize they'd made some misleading investments. We've covered in depth why specific investment strategies are to be avoided. What then should we do with our money? This leads us to our second topic that's discussed in the book, the power of the index fund. An index fund is more cost effective than an actively managed fund. By definition, it holds a diverse index of stocks that reflect the financial market as a whole or a particular sector. They're also designed to be buy and hold stocks. Rather than trying to time the market with specific stock highs and lows, in this way they can also be defined as relatively passive. They track market trends overall instead of individual contributors. Over time, they are likely to outperform actively managed funds and deliver actual tangible returns for investors. While some might argue that investing in this way eliminates the potential for high risk, high reward scenarios, no single investment strategy is foolproof. Remember that you aren't locked into one specific investment style. Leaving a small portion of your portfolio for higher volatility investments is always an option. Okay, so you're sold on the idea that index funds are one of your more promising investment strategies. How on earth do you go about selecting the right fund or funds for your needs? Each index fund has an expense ratio accounting for management and operating costs. Though typically totaling less than 1%, these expenses can take away from long-term investment returns. For example, the annual expense ratio of the Fidelity Spartan Index Fund is 0.007%. At the same time, the JP Morgan Index Fund is 0.53%. Both funds have expenses of less than 1%, but over a decade, and depending on the size of your portfolio, those tenths of a penny add up. Since you can expect these funds to fluctuate with the overall market, it's best to simply choose the fund with the lowest cost structure. A higher expense ratio doesn't necessarily indicate higher rates of return in the future. Trendy index funds may further muddy the waters with promises of higher returns through novel stock picking strategies. This results in a higher cost structure. Here's an example. Some investors don't build their portfolios using the traditional method of weighted market capitalization. Instead, they may determine the proportions of each stock in their portfolio based on other factors like quarterly profit or the amount a company pays in dividends. Using trending data in this way still makes it impossible to predict which trends will be successful in the long run. You should still exercise caution and prioritize low costs. That's why many investors choose not to invest directly into stocks, but instead put their money in an actively managed fund. Money is pooled from multiple investors and then invested in stocks by specialized fund managers who evaluates and revises the stock portfolio on a regular basis depending on market conditions. Unfortunately, such an investment is dangerous. Why? Because the fees associated with investing in such a fund are extremely high. As an investor, you'd be responsible for paying brokerage commissions, fund manager fees, and other expenses. All of those fees add up to a significant portion of your anticipated profits. You might not mind the fees if the funds performed exceptionally well, but actively managed funds are more likely to lose money in the long run than the overall stock market. But how is that possible? For one thing, speculating on stock prices is not a long-term strategy. You might think that a fund can make a lot of money by buying stocks when they're undervalued and selling them when they reach their true higher value, but in the long run, this strategy can't make more money than the underlying companies, which is reflected in the stock market's overall performance. When you combine this pitfall with the fund's high costs, all actively managed funds will generate significantly less profit for you than a passive, low-cost index fund that simply mimics the overall market's performance. In fact, if you had invested $10,000 in 1980, by 2005, you would walk away with 70% less if you invested in an active fund rather than an index fund due to fees alone. Despite what you've just learned about fund costs, you may still want to consider investing in an actively managed fund. However, before you do so, think about how well those funds performed in comparison to the overall stock market. Regrettably, they most likely do not. The majority of funds fail to generate significant returns or go bankrupt. Investors pay large fees to funds entrusting their money to financial experts with extensive knowledge of the stock market. Despite their industry knowledge and expertise, only 24 of the 355 mutual funds that existed in 1970 have consistently outperformed the market and are still in operation. With these facts in mind, paying for financial experts to manage your fund would be a waste of money. Even profitable funds cannot guarantee future performance. You might decide to put your money into funds that can continue to outperform the market on a consistent basis. Even if you look at their track record, the conditions that led to the fund's success over the past 35 years may not repeat themselves in the decades ahead. For example, if a fund has consistently outperformed the market over the last 35 years, the fund manager is almost certainly responsible for its success. The manager, on the other hand, will inevitably retire at some point. How do you know the next one will be as successful as the first? Furthermore, future investment opportunities will be distinct from those of the previous 35 years. How do you know what future investment opportunities exist? Given how poorly most funds perform, you might be wondering why people continue to invest in them. To begin with, investors frequently undervalue the true cost of actively managed funds. Actively managed funds, as you've learned, come with a hefty price tag. Fund managers, on the other hand, rarely reveal the dollar amount. Instead, they brag about the high returns while failing to disclose what the investors will actually earn after all performance and portfolio fees have been deducted. Surprisingly, that omission occurs frequently. In the late 1990s, 198 of the 200 most successful funds reported higher returns than the investors actually received. Thirdly, let's consider the idea that despite the very real possibility of failure, ultimately, you've got to be in it to win it. In many areas of investing, people are prone to allowing their emotions and current market trends to guide them. People make poor investments all too often because they are swayed by popular opinion and clever marketing. Take, for example, the late 90s high-risk investments. In contrast to the first half of the decade, when only $18 billion was invested in the stock market, in the second half of the decade, when the market thrived and the stocks were overvalued, $420 billion was invested. When the bubble burst, it was too late for people to realize that they had succumbed to the popular hype. Similarly, investors pour money into actively managed funds because everyone else is doing the same thing. So, if you shouldn't invest in actively managed funds, where should you put your money? Don't let what you've learned about actively managed funds convince you to keep all of your cash under your mattress. Your best option is to invest in an index fund. Index funds are much more cost effective than actively managed funds. An index fund, by definition, holds a diversified portfolio that reflects the financial market or a particular market sector. Index funds, on the other hand, hold their portfolios indefinitely rather than betting on the market, avoiding the risks of making short-term volatile bets while lowering operating cost. Index funds are also known as passive funds because they track the performance of all stocks in the index without betting on individual stocks. You will not have to pay operating fees or buying and selling shares, financial consultants, or fund management because they simply hold their shares across specific market sectors. However, you will benefit from commercial net returns. Another advantage of index funds is that over time, they are more likely to outperform actively managed funds. You could argue that keeping stocks in your portfolio indefinitely rather than buying when they're cheap and selling when they're expensive results in missed opportunities. However, you already know that the stock market's rises and falls eventually level out at the stock's real value over time. Index funds typically outperform actively managed funds in the long run as a result of the net effect. They provide returns based on the real value of the stocks while eliminating active management costs. Be skeptical of the latest investment fads whenever you're considering where to put your hard earned money. Index funds compete fiercely, resulting in a never ending cycle of new trends. Index funds were first introduced in 1975, and there are now 578 of them competing for your money. Long established funds compete by lowering their costs as much as possible in order to attract discerning investors. Meanwhile, new funds entering the market try to entice investors by promising higher returns through novel stock picking strategies. As a result, they charge a higher price. Remember, no matter how a fund claims to work, it's nearly impossible to know which stocks are overvalued or undervalued. So, stick with funds that maintain a traditional portfolio. Throughout this video, we've proved John C. Bogle's point: investing in actively managed funds is a bad idea. It's a surefire way to have your hard-earned cash slowly siphoned off by financial intermediaries with no guarantee of success. However, investing in index funds widens the rate of success and makes for a less stressful and better diversified portfolio. Place the majority of your assets in an index fund, and if you want to take a chance with your hard-earned cash, invest a small portion into actively managed funds. If you still want to experience the thrill of risk and hopefully make quick money in actively managed funds, stick to the maximum of 5% of your total investment portfolio. You can afford to take small, calculated risks while keeping most of your assets in secured long-term investments. Thank you so much for watching, and if you like this video, please share it with your friends and family. It helps the channel a great deal. Leave in the comments section your thoughts about the video and who I should cover next. With that said, thank you guys so much for watching this video, and I'll see you in the next one.